You've probably been told that real business funding is off the table until your personal credit is perfect. That is not my experience in my 10 years in this industry. In this video, I will walk you through a clear process entrepreneurs use to access at least $50,000 to $100,000 in business credit, even if their personal credit is not where they want it to be. You will see how to set up your business correctly, how to build a credit profile that vendors and lenders trust, and how to move step by step into larger approvals without putting your personal life at risk. I'm Zach Siegel, founder of Small Biz Heroes. I left a comfortable job on Wall Street because too many owners were out there being pushed into one loan option that didn't fit. At Small Biz Heroes, we educate first and we fund businesses second. We help businesses acquire lines of credit, SBA loans, term loans, equipment financing, invoice factoring, equipment sale leasebacks, working capital, revenue-based financing, 0% APR business and personal credit cards, and regular ones as well. And we do it in a manner that is strategic. And we also do cash advances, but only when necessary, and we use it as a bridge to a better program. My goal is to give you the full menu and the sequence that earns better and cheaper options over time. That way your business stays around longer and grows more efficiently. Before we get to step one, you'll want to lock in your business address first. That's step number 0.5. Choose a professional business address that you can use everywhere. Then use that same address on your entity filing, your bank account, your utility accounts, your business bank account, your website, and any vendor applications for trade lines. Consistency removes friction. Inconsistent records slow approvals and trigger extra requests from underwriters, and we don't want to do that today. Step one, build your fundability foundation. Start by having your professional business address you will use everywhere. Then register your entity using the same address and obtain your employee identification number or EIN. Open a business checking account that matches the address on your filings and route all business income and expenses through it. Use a business phone number and a domain email. Publish a simple site that lists what you do, who you serve, and how to contact you. And I know that these details, they seem small and nuanced, but they are the first impressions that underwriters see before they even look at your financials. Step two, create early reporting with vendors and something like a fuel program. Business credit does not build itself. You have to do it intentionally. Add 3 to 5 vendor trade lines that report to Dun & Bradstreet, Equifax Business, and Experian Business Credit. Use vendors that you truly need for things like packaging, supplies, software, maintenance, or logistics. Add a fuel program if your team drives. Place small monthly orders on each of these trade lines. Pay on time or early, preferably early. Early payments often score better and help your business credit ratings. Important nuance. High utilization on vendor trade lines does not hurt you the way it can on revolving cards. A lot of people don't know this. Use those vendor terms heavily if it supports your operations. Then pay early or on time. After 2 confirming cycles, confirm that the trade lines are actually appearing on your business credit reports. Step 3. Expand to revolving business credit and store lines after you have at least 6 trade lines reporting. Apply for 1 or 2 business credit cards that report to the bureaus as well. And make sure that they actually report. There's a lot of Amex business credit cards that don't. And then consider store programs like Costco or an Amazon business account that you can obtain under your EIN. Keep card utilization low, ideally 10 to 30%, and then pay in full or aggressively every single month. The issuer will reward that behavior with higher limits over time. Continue placing vendor orders so that your file stays active. Why not? You get cool stuff for it anyway. And then step 4, add specialized lines, including fleet credit and vehicle credit if relevant. Many dealerships and captive finance companies evaluate business trade history, and now that you're on step 4, you've got some. As an example, some vehicle programs expect roughly 9 reporting trade lines before they will consider an approval in the business's name. When you reach that tier, explore fleet, vehicle, or equipment lines that directly support revenue-producing assets and only report to your EIN. Step 5, map lenders to your use of funds and apply with intent. Not every lender values the same data. One may care most about time in business and average daily balance. Another may weigh the number of trade references that you have. And then another may prioritize revenue stability or net profitability. Your job is to match what you need to the lender that values what you already have. Here's some examples. If your use of funds is to bridge receivables, a line of credit or even revenue-based financing with strong prepayment incentives could beat a term loan. If you're buying equipment financing usually beats every other program. If you're carrying large outstanding receivables and invoices that are going to pay you on net 30, net 60, net 90 terms from your commercial clients, then accounts receivable financing would be the best bet. The strategy is simple. Build a short, targeted lender list for your industry, time in business, cash flow, and credit profile. Then request offers in a tight window while your reports are freshly active. And make sure to ask whether or not they do a hard inquiry up front. If they do, you might want to look into another lender because most lenders don't nowadays. Step 6, make your bank statements look like a lender's best case. Underwriters review the last 3 to 6 months of business bank statements and make sure that you're putting your money into the business checking account and not your personal account. They look at average daily balance, negative days, deposit rhythm and frequency, and then the ratio of deposits to debits. Aim for 0 negative days preferably, and then keep a cash cushion equal to at least 10% of your average monthly deposits in the bank at all times. That being said, don't batch your deposits in one lump sum too. Make sure that you spread out your deposits because if you deposit every 10 checks into the bank at one time, then they're going to think that those 10 checks really came from one client or one contract, and it increases your risk profile. Avoid needless transfers between personal and business. Pay vendors on predictable days. That rhythm reads as stability, which translates into better terms. Now, these things might seem nuanced again, and they are, but these are the things that underwriters and lenders look at that for some reason this industry doesn't want you to know. Step 7, show momentum in your net profitability. Many bank scorecards reward increasing net profit month over month or quarter over quarter. Revenue is good, profitable revenue is better. If you have a seasonal dip, note it and be ready to show the trend line recovering. Vendors often do not care about profitability, but banks and captive finance programs do, especially for larger, more conventional lines. Common mistakes to avoid. Do not shotgun applications all over the map and apply with a ton of different brokers either. Coordinate a small number of well-matched applications so you can control inquiries and submissions. Quality over quantity. Do not mix personal and business funds. Pay yourself on a consistent schedule. Do not ignore address mismatches on filings. Fix them before you apply. Do not max out business credit cards. Keep utilization modest on those lines and keep it predictable. And last but not least, do not chase viral hacks. These hacks do not report, they over leverage you, and they do a lot more harm than good. Here's a compressed timeline you could follow. Days 1 to 30, lock your business address, match all records, and open the business bank account. Add 3 reporting vendors and a fuel program or gas cards if relevant. Make small purchases and pay early. Days 31 to 60, add 3 more reporting vendors. Apply for 1 business credit card and 1 store program, like an Amazon business account. Keep card utilization under 30% here. Confirm that your trade lines are reporting by going to Equifax, Experian, Business Credit, and Dun & Bradstreet to make sure. Days 61 to 90. If your statements are clean and your trades are active and in good standing, request a moderate limit increase on the card. Then apply to a bank or a specialty lender whose scorecard fits your file. If your use of funds is equipment, apply to an equipment lender. If you run vehicles, explore your fleet or vehicle credit now that your trades are seasoned. Keep paying vendors early. Keep the bank cushion at 10% of monthly deposits. Here's a quick case study. Maria runs a bakery with 13 months in business. After she maxed out a personal card to buy an oven, her personal score dropped to the mid 600s. We set up 4 reporting vendor accounts for packaging and ingredients, and we added a gas card program so that she can make deliveries easier. She paid early, and then after 2 reporting cycles, she secured a basic business card and a Costco business account as well under the EIN, and she kept utilization near 20%. That whole time, we were also working on her personal credit in the background, and she became a very good borrower. 3 weeks later, an equipment lender approved a $40,000 equipment line of credit so that she can even start building her industrial manufacturing out. Her personal score got a lot better because she made the right strategic decisions. Here's another one. Devin runs a small logistics company, just a couple trucks. His personal credit sat near 610 after a medical collection. Happens to the best of us, right? Revenue was strong and growing. We opened 4 reporting vendors for maintenance and supplies and a fleet fuel program that reports. Then we added a secured business credit card that after a few months converted into an unsecured card, and we made sure that he kept utilization under 25%. At month 7, we got an alternative financing company to approve $75,000 based on receivables and clean historical statements. A fleet vendor increased limits after 90 days for them as well. Because the file told a clear story and profitability was improving, a bank extended an additional revolving line without a personal guarantee after all this. Here's a few questions we get all the time. Can somebody in the 500s in terms of personal credit still get funding? And the answer is yes. With strong revenue and clean business bank statements, there are paths through revenue-based products while we build the file towards lower cost options and work on your personal credit. Do I need to keep vendor utilization low? The answer is no. Use vendor terms heavily if it helps your operation. Just make sure that you pay early or on time. Keep revolving card utilization low. When should I try for fleet or vehicle credit? The answer to that is simple. When you have at least 6 to 10 vendor trade lines reporting to the business credit bureaus, that'd be the time to start. How much cash should I keep in the account? A simple target is 10% of your average monthly deposits as a cushion. Quick wins for faster approvals. What matters more early? Number of trades or size of limits? Early on, 3 to 5 clean references beats 1 large limit with no history. Should I pay early or on the due date? Pay early when you can. It often codes as very strong behavior and will raise your business credit score much higher than the average. How long should I wait between application submissions? Coordinate them in a short intentional window after your trade lines post so the data is fresh rather than firing off random applications to a ton of different places. Which matters more to banks? Revenue or profitability? Both matter, but many scorecards weigh profitability heavily. Is it okay to accept a small personal guarantee early? If the terms are excellent and the use is productive, it can be strategic, especially in the beginning. The goal is to earn the option to say no to a PG. We never guarantee approvals. That means that every decision you make should be based on real numbers, not hope. If you want me to personally review your current setup and show you exactly what you qualify for right now, I will do a free evaluation. We will look at your entity, your trade lines, your business bank statements, and your goals. Then map the fastest, safe route to approvals that fit your business and where you're at. The link's in the description. Click it, pick a time, and we'll do this together. If this was helpful, subscribe for more content that protects your future and opens doors to real funding.